I was born in India. I moved here when I was a teenager. I spent 25 years here in the U.S. before moving back to India as part of DFJ, when I joined DFJ as partner in Bangalore for 5 years, and a couple of years ago I moved back. So I'm too Indian for Americans, and I'm too American for Indians. That's what it means, basically, in that particular context. So I sit on 8 different boards of companies in India. Over the last 7 years, I've been managing that. And as a matter of fact, I just flew back from Delhi on Friday night, and I took the red eye from the West Coast this morning. So that's commitment for you to the HBS folks. Even though I'm not an HBS grad, there you have it. But want to get more into it as we get into the Q&A.
So I think I'll start with the story. When I was about to join Blackstone, I said, Steve, I'm not sure you're really committed to India. He said, what will make you sure? I said, look, I want you to commit $1 billion to invest in India. I said, $1 billion is a lot of money. I mean, if you're talking about 2004, he said, I'll be happy if you do only $500 million in the next 5 years' time. So summarizing our experience, we actually got $4 billion of equity approved from our investment committee and $1 billion of real estate. And we actually did $2 billion of private equity and $1 billion of real estate. Given that we lost at least a year in me setting up the office, we lost, because of global financial crisis, almost 1 year freeze of no investment in India. And also because of the governance crisis in India, I think in spite of all the problems that we hear, which are all true, it's very difficult to work in India, 140th in ease of doing business, 180th in terms of enforcing contracts. I think we still did a pretty good job investing $3 billion in India. So overall, frustrating, but pretty rewarding.
Thanks, Akhil. I'd say my experience in India has been a bit more conventional. Went back to India in '06 after spending a bunch of years out here with Goldman Sachs to start their India office and to head out their private equity business. I thought that was a good way of transitioning. Got to learn a lot at the firm and really had the autonomy to go and do a lot of interesting things in India at that time. I think the KKR experience was great learning as well, because I was spending a lot of my time on the larger end of the market. And now at C-Link, I think I've come full circle, because I'm really trying to see where the opportunity is in India. And the conviction that I have that the smaller or the lower mid-market, if you will, is where I see the biggest opportunity. So I look forward to talking to all of you a little bit more about that.
Thanks, Hiram. It's an honor and a pleasure to be here, so thank you. I was HBS class of '97, and I decided in '97 to try to go back to investing in India. The only job offer I got was paying me $20,000 a year as a young venture guy in Bangalore, so I couldn't afford to take that given all my loans. So then I joined Goldman in Singapore, where actually Hiram and I were close colleagues over there. And then in 2000, 3 years after HBS, started Westbridge as a venture fund focused on cross-border US-India, and have been now investing in India since '97. And the way I would characterize the last 2 decades is India is a place where the medium to long term is fantastic, but the short term often feels like 2 steps forward, 1 step back. So there's, I think, one of the tricks in India, probably like any emerging market, although India is the only one I've really been exposed to, is managing cycles is really important. We were joking about this, Hiram and I, earlier, but this room is packed. I think the last HBS India conference I came to was 4 or 5 years ago. It was relatively more moderately full. So this is a sign that there's a lot of excitement about India today, that there's so many of you here with an interest in India. And I do think there's a lot of cause for optimism. Certainly, I've never been more optimistic in the last 20 years about my own country. So I think there's a lot of, it's a very, very interesting time to look at India.
Thank you. So I'm going to ask 3 or 4 questions over the course of the next, say, 40 minutes, and then I'm going to open it up to the audience so that we can engage with the panel directly and have questions. But just to kick off, so obviously politically, apparently, achhe din aa gaye, or the good days are here. but from your perspectives as managing money, investing in India, have achhe din come for you as well, which means what's LP sentiment, and is there money to be raised from institutional investors around the world to invest in India? Because as you said, Samir, absolutely, it was completely and totally the opposite even till about a year ago. So if we can kick off with that, you think what is sentiment in the LP community for India? What are the key drivers, and is likely to be different? And if it's likely to be different, how so? Or what types of investors might be looking at opportunities in India?
Great question.
Maybe I can kick off, and then you guys can add to that. My sense is that clearly, given this backdrop, people are intrigued and want to have the conversation. But there are two things that have really happened, which are, I would say, influencing people's decisions, right? Number one, most importantly, people have made a lot of money in the US. And so I think when it comes to taking the risk perspective of investing in India with all of the issues that I think you're all familiar with, including FX, I think there's a lot of pause, if you will, from LPs to really think through whether that's the risk that they want to take. Second thing I would say, again, from the LP front is a lot of the folks have lost money in India, or at least haven't seen their money come back to them. And so I think, you know, once bitten, twice shy, they are a lot more careful when it comes to partner selection and really making sure they understand very specifically the GP's strategies. So I think LPs have become a lot more focused on those types of matters. Having said that, clearly the macros are helping. You know, my sense is, you know, people are chasing yield right now, and when you think of other places to invest outside of the US, India shines pretty nicely on a relative basis.
So I think in 2004, that's the time when pretty much most of us went there. KKR, Carlyle, Blackstone, and you know, Warburg was there before, but a couple of us followed a little after. But that was time, you know, the decision makers here were saying, India, we have to be in India, and obviously, Indian macro looked great. The UPA government was in place. Fast forward today, I would say the scenario that Blackstone came and other private equity came to invest in India is actually valid, and even actually more valid today. The problem is, as Hiram said, the last 10 years or so, investors actually understood what risk in investing in India meant. Previously, I don't think any of us were focusing on the risk. We were focusing more on the Indian opportunity. Now, the Indian opportunity is as good, looks better, but the problem is that how do we overcome some of the skepticism that people have? One of them is the currency depreciation. I mean, nobody expected Indian currency to depreciate so fast. And if you're a dollar investor, even in rupee terms you did well, you're screwed because you lost 30, 40% just like that, right? Second thing, I think the kind of regulated risk people have experienced, like for example, those of us invested in power plants, so for example, coal-fired power plant. I remember when we went to an invest committee and we were showing 3.5x return on this investment. And it was basically based on the fact that you have a coal mine which is coming along with this power plant. And I remember Tony James asking me, but tell me how can the government take it away? And they kept pushing and pushing and pushing, and I finally got frustrated. I said, look, India is not a banana republic, right? These mines will never go away. You all know what happened to the coal mines, right? So I think people have understood that the risk from India could come in ways that you don't anticipate. So as I think one of my colleagues said, people are still saying, okay, India has a potential, and actually, among the large economies, India has the best potential. I can't think of any country that has as good a potential as India. And the question is whether it be realized now or not. On a risk-reward basis, I will say this is the best time, even a better time now than it was when we entered in 2004.
So a couple of comments I'll make. I was here last year, and for those of you who are in the room, I created an inverse Newtonian law, which basically said everything that goes down must come up. Those are my words. And I was referring to the fact that I'd just come back from my trip to India, doom and gloom, back in February of last year. And the last 6 months, of course, are complete euphoria. Now, you know, DFJ is an early to, let's say, mid-stage tech investor, writing, you know, $3-4 million to $8 to $10 million. So that's sort of noise level for most of my colleagues here, but significant still for us. A couple of comments I'll make around the LP interest. One is I actually decided to move back to the US a couple of years ago. And what's been amazing, especially in the last 6 to 9 months, are the sheer inbound queries that are coming from LPs simply asking me, hey, Mohanjit, would you be willing to do a bulk secondary of your India portfolio? Are you, you know, if you're sort of abandoning the country? I said, I'm not abandoning the country at all. I had to move back for personal reasons, but I still continue to manage the portfolio. But the fact of the matter is, there are probably close to, you know, 12 to 18 such firms who are interested in getting exposure to India, especially in sort of, let's say, mid-stage tech that they otherwise would have walked away from, you know, 2 or 3 years ago. So that's, you know, that's one, you know, one component of it. The other, which is really interesting, and you know, there are some firms, some sandhill firms that are falling in this, I don't want to say trap necessarily, but it is reality, which is that we went into India back in 2005. So let's say it's been 10 years. And in those 10 years, the exit environment, at least again, for these tech companies has been relatively non-existent. Now, I mean, Bhavish is here and other sort of e-commerce, you know, emerging players are here. Of course, the sentiment has shifted drastically. But if you can imagine the GP-LP conversation that happens, where the LP says, wait a minute, you know, we've been in you guys for the last 10 years, the money has gone in, it hasn't come out, that becomes a difficult conversation to have after a while. And that's why, you know, some of the firms, Kleiner and Canaan and so on, have decided to pull back because they were in it for 10 years without any returns, while they were seeing meaningful returns from the same dollar funds here in the US. So that's just a little, you know, perhaps contradiction. And I think from a timing standpoint, Canaan and Kleiner will realize they pulled out absolutely at the wrong time. But I just wanted to give some insight into, you know, what the decision making is between these GP-LP conversations that happen behind closed doors.
I'll add just one brief point, just supporting what Mohanjit's saying, which is, you know, a different way to look at this is most investors in the world, unfortunately, invest with a rearview mirror. You know, so what does that mean? What that means is what they're willing to invest in now is what did best in the last 12 months, right? Which is often the opposite of what you should be doing, but this is just human psychology, human nature, behavioral finance, etc. So if you look at venture in the last 12 months, to Mohanjit's point, there have not been a lot of exits, but what has happened is the creation of some massive companies, as we heard in the e-commerce panel earlier, where a Flipkart, 4 or 5-year-old company has gone from 0 to 6 or 7 billion in revenues. Now, you can argue it may be burning a lot of cash, and you can argue about its future, but I can tell you that in the venture business, a lot of the venture business is about getting to scale fast. That has never happened in India before. For a company to go 0 to 6 billion in sales in 4 or 5 years, it's simply unheard of. So a lot of smart LPs are looking at these proxies for future returns in the venture business and funding a lot of new venture funds. So I think pretty much the entire venture community in India right now is raising money. SAFE just raised a $350 million fund. Nexus is in the market. A bunch of others are raising money. So I think you're going to see 2015 be the biggest year ever in history for venture fundraising for India, where there'll be a whole bunch of new funds raised, mostly by the existing guys and perhaps some new guys. And the other side that's doing really well is the public markets. We were the best performing major emerging market, stock market last year. And so there's a lot of interest in that category as well. We do both public and private investing. On the private investing side, as Hiram and Akhil were saying, it's been tough because a lot of LPs have put a lot of money in, but very little has come back. But even there, we're seeing signs of optimism. So for example, in the last month, there have been 2 private equity IPOs that were backed. And if the public markets hold for the next 12, 18 months, our expectation is a lot of these private equity backed companies that have been private and waiting to get out are going to hit the market. In fact, several from our prior funds are also hitting the market. And once that cash goes back to the LPs in the private equity world, that's the magic loop that hopefully will get completed and sort of reignite the private equity side of the business. And then there's another category of LPs which has not invested in India, and they are the most optimistic because they haven't been burnt, but they're hearing the optimistic stories. So that's a category that I think today looks quite interesting if you're fundraising.
Thanks. So that sets up the second question very nicely. Some part has already been addressed, but maybe we can focus a little bit more on the private markets. So the public markets have done quite well. Last year, as Samir said, the Indian public markets was perhaps the best performing market in the world, at least in the big economy category. And the venture business or the early stage investing business seems to be finding feet. So is there any space left for the private players in the middle? Or is it really the India opportunity, this entrepreneurial ecosystem, you access it through the startup world and kind of scale quickly? And then if you really want to play in the other side of the business, do not bother with private equity and just go at the other end in the public equity markets where, at least you're more liquid, which seems to be the biggest problem in the Indian market. So is there even a place for the private markets or real assets? Can I start with Akhil maybe, and then Hiram, or whichever order?
Well, if you look at Warburg Pincus, private equity player, 70% of the investments actually were in public companies. So public companies also need money, and public companies can raise money through private investors. Now, one of the problems in India is that companies tend to go public much, much, much earlier than they can go public in the United States. So private equity in India does not mean investing only in private companies. You could invest also in public companies. In fact, after my experience in India, my submission to Tony and Steve, if I have to redo India again, I will invest with the private equity mindset in the sense that I will have a 5 to 7 year horizon. I'll do the kind of a due diligence that you do in a private equity. I won't be a trading mentality. But I will invest in public companies only, right? Because public companies also need capital, and many times stock markets are shut for whatever reason, not even for domestic reasons, sometimes for international reasons. And there's plenty of opportunities for private equity players, so-called, to invest in public companies. And the advantage in public companies is that in a private company, you're not sure, and that's one of the biggest risks that private equity investors have, is the promoter risk, and the quality of the financial statements and the quality of governance is a big, big risk. But if the company has gone public, then besides being afraid of only your private investors, a public company also has to be afraid of the regulating institutions, which is a much bigger risk, because you can get away fighting with the private equity player because will get locked in the courts. In fact, 2 of my companies, we had some disputes. And they said, oh, you want to fight with me in the court? Go ahead. I'll lock you in the court for 5, 6 years. And by the way, your cost of capital is very high. So, that's kind of, they have a leverage. But if you are a public company, then you have to be afraid of what SEBI might do to you or what some other institution might do to you. So today, my formula, if you have to take not as much risk as a private player, and anyway, even if you invest in private companies, you get benchmarked to the public comp, so there's no advantage. I will invest in a 7-year fund or 7-year horizon in public companies in India. That'll be a much safer way to do it than taking all the risk of, sort of illiquidity and the governance issues. The other advantage you find in public companies, when the stock markets go down for no reason, the company is performing well, then you can buy more, right? If you are invested in the public companies, but you can't buy more if you're invested in a private company, because the entrepreneur will never sell at lower valuations.
I have a slightly different view to that. While I agree with Akhil about the opportunity in the public markets, I actually think there is a huge opportunity in the private market space as well. And the reason I say that is because, like everything else, you need to analyze the industry at a little bit more of a micro level. The industry has gotten segmented at this stage. After a decade or a decade and a half, it has matured where you have the food chain of private equity falling into place. You've got the venture guys, you've got folks who are willing to write smaller checks, and then obviously there's been a lot of capital that's been raised for people who want to write 40, 50, 60 million dollars, and then you've got the big boys out there as well. The way at least we see the industry right now, we think there's one disruptive force that's taking place in private equity, which is the advent of the sovereign wealth funds. If you think about the likes of Khazana, Temasek, GIC, the Middle Eastern folks, and then most recently the Canadians, they've come in a very large way, and they all want to write large checks and do minority investing. And so I think that's putting a lot of pressure to, as to where the likes of the KKRs, the Blackstones, the TPGs, as to where they need to start deploying capital. So maybe they go into the public market realm, as Akhil pointed out. Maybe they have to focus on control deals. But I think we all know the challenges, the adverse selection issues when it comes to control in India. But the opportunity really needs to be around doing some micro supply-demand analysis as to where the capital is. And I think there's a lot of capital chasing, large deals in India today. But we feel that the smaller companies in India, especially non-tech, are capital starved, and that might be a good place to be looking for investments. And so, like anything else, I think themes or investment theses might change with cycles. But right now, just given everything that's going on, it feels like the opportunity has moved to the smaller market segment.
Yeah, couple of points. Again, taking a view more from a tech standpoint. So, if you think about the tech venture ecosystem in India, it is ridiculously small compared to clearly a much more robust and mature ecosystem like the U.S. Right. So there's tremendous headroom, and I am looking forward to the fact that there'll be more funds raised, new funds raised by new players, and as well as by existing, venture funds that really, in the scheme of things, have only been around. I mean, Sumir really is one of the forefathers, if I would say so. Yeah. He looks very young for a 65-year-old. I always, as an aside, I always say, we're Desis, right? We're Indians, so it just takes us longer to get there. So I am only 25, and Samir's finally gotten up to about 18, I think. No, but going back, so here's something really interesting. So I just came back again from India, and I usually go for 6 days. I spend 2 days each in Mumbai, Delhi, and Bangalore. And every time I go, right, congestion is more. Delhi is miserable right now with the pollution, and I guess it's amazingly surpassed even Beijing. And so when I look at all that, and while I hear Adil and I'm fascinated with what the PM is doing, I think a lot of changes around the environment, around convenience, around quality of life is actually going to come from new entrepreneurs. It's going to come through tech-enabled solutions that's going to make life easier. And if you think about it, everybody talks about we're the Uber of this, or since Bhavesh is here, we're the Ola of this or Ola of that. If you think about it, India has been doing this for decades, right? We all had our Chotus and Ramus and so on calling. It was analog, right? So it was sending somebody to get the convenience to our house, but it was coming. Now the West, of course, has found the remote control of our life in this smart device, and it's happening. And what's interesting is that loop is going back to India, where initially the Chotus and Ramus may have been, a luxury for the top of the pyramid, and now what's happening is the largest democracy in the world is actually getting democratized in terms of these solutions coming back as the smartphone penetration takes hold. So even the belly of the pyramid, or the mass sort of middle class, has so much opportunity, and I think it's the entrepreneurs who are going to make that happen. So I'm extremely bullish And to Sumir's point again, I think you have to take a 10, 20, 30-year approach, not a 1, 2, 3 quick flip approach to investing in India. And I think if you do that, I think it'll be a fascinating, fascinating ride over the next 20 to 30 years.
So what I'm hearing is that this is a long-term opportunity, and as Keynes famously said, in the long term we're all dead. So what do investors in the short term or 8-year or 10-year funds do if this is a 30-year opportunity? So is it almost better, since we've been seeing the emergence of debt investments in India, is it almost better to, if you're looking at India with a 5-10-year horizon, to be a debt investor rather than an equity investor and play in that space? And have direct investments from the sovereigns and the large pension funds in the private markets, people who can afford to take a much longer term view?
Actually, if you look at last year, for the first time, the debt investing in India equaled equity investing. It was 20 billion each. I don't know how many of you know that, but to that kind of supports a little bit of what the perspective that international investors took. And part of the reason why debt became quite, there were two reasons. One was that they were not as sanguine on the equity part, because equity required, as you said, not, although I don't agree, it takes 15, 20 years, but longer horizon than they had. And the second was, I think they got a little more comfortable on the direction of the rupee, so the yield became very, very attractive. Even the first quarter, I'm told that there is a equal debt and equity is roughly 5 billion each. No, that'll be too much. Anyway, debt and equity even this quarter is pretty much equal, which never happened before. Now, my personal view is that I don't think investors have to take such a long-term view that we're all dead. But I think there's a rational case for taking a longer view than you take for investing in developed markets, because when you have a little more volatility, right, then and there's lot and consistent growth. I mean, you don't come to India for restructure investment; you come for growth. So I think taking a 7-year view rather than 5-year view is a rational thing, because you have a little more volatility, right, and you have growth. So if you don't make it up in 5 years, and this is my view has been that if you select the companies right, then I don't think you'll be wrong in your MOIC. You may be wrong in your IRR, in the sense that you can achieve the same MOIC in 7 to 8 years versus 4 to 5 years that you may anticipate if you go wrong. If you've done your diligence well, and if the promoter has not been a dishonest person. So that's kind of a adjustment, I think, rationally speaking, you require, because India is both a growth economy as well as more volatile, because of, we're still a small economy compared to the global forces that act upon us. And the last few years has been a pretty good example. No fault of ours are, because of global financial crisis, our economy was doing well, but stock market dropped from 20,000 to 8,000, right?
I'll add one more thought on the credit side, which I could raise. I think credit in India is a great market. We're investors recently in the last 12 months. We made 2 investments in credit lenders, specialty lenders. One is a company called Vistar that makes loans to micro SMEs across India. And that company's doubled its loan book from about $50 million a year ago now to about $100 million, and is keeps doubling, very profitable, and lends, believe it or not, at 26% a year interest rate. And the reason they can do that is because the Reserve Bank of India is very conservative in many respects with banks, makes banks put a quarter of their money in government bonds, limits the leverage on banks. Banks aren't that levered, and lots of other restrictions on banks, so that if you look at the Indian consumer and Indian SMEs, they're very, very underlevered today. So there's a huge credit opportunity. Some of the excellent points that Akhil made on the 20 billion that came in last year, that would have been 40 billion if the government of India had not capped GSECs at, I think it's about 30 billion. So government securities today, there's a foreign ownership cap of $30 billion, but I can tell you that if the government of India took that out tomorrow, there'd be as much demand as they would choose. So it's, in fact, despite the 20 billion coming in last year, it was only because government of India sort of restricted foreign investors from coming in, because in a yield-hungry world, Indian yields are still very high. And so particularly now that we've got the currency crash behind us, what Akhil was speaking about earlier, that rupee lost a third of its value, and the macroeconomy stabilizing, people have taken a more constructive view on the rupee. And so that's what you really worry about. If I get a 10, 12% yield in rupee terms, will it be 10, 12% in dollar terms? Or will the, if the exchange rate weakens, will it eat away a lot of my return? But today people are feeling more comfortable that the rupee dollar is more likely to be stable. And so there's a lot of interest in credit.
Sorry, can I just?
Yes, of course.
I just want to add one perspective to this, because I think the comments that obviously are being made are right, but are still at a very macro level. I think when you look at the micro in India, and I think that's where credit starts becoming a little more tricky to analyze, because if you think of who requires credit in India, the point that Sumer made about his portfolio company, I think it's the smaller companies which are starved of liquidity. And banks really either aren't willing to lend to them or don't have the ability to get to them, which is what's creating an opportunity for these specialty lending companies. But when you look at analyzing credit, you're still taking on the same type of promoter risk as you are on the equity side. I don't think the bankruptcy code has been tested in India yet, and you don't really want, as to the point that Akhil was making earlier, you don't want to fight the promoter in the courts either. So I think it's, while the going is good, credit looks really good, but once you start hitting a few NPAs, it can take away a lot of your bandwidth as investors are concerned. So I think I'd be more careful about going down that asset class.
Thank you. Well, the good news is that SARFACI has been extended to NBFCs in this new budget, so hopefully that helps the debt markets in a big way. And the other thing is that most Indian promoters are so attuned to building companies by borrowing from the nationalized banks or from what have you, from the gray market, that perhaps you can have debt type protection and equity type returns. Who knows? Time will tell. So that brings me to my last question before I open it up to the house. I'm going to become micro, and I'm going to put all of you on the spot because I can. And here's the question. So we say India is a great opportunity now going forward, hopefully, with all the tail risk that still exists perhaps. But specifically, what have your returns been, and what are you promising investors returns will be in the near future or over the long term, net of fees, taxes, and exchange rate?
I think we'll start on the right.
We are pretty proud of our record, and I think we are looking at our current portfolio of $2 billion returning about 1.9 to 2 in dollar terms and 2.6 to 2.5 in rupee terms, which, given the fact that we had a global financial crisis and a couple of companies got affected by that, given the fact that we had India's governance crisis, I think it's pretty good going. And if you and clearly, our investment is showing us a huge amount of learning curve, that if you take the last 6 investments, they're much better than the first 6 investments in terms of both the volatility, consistency, and all this stuff. And that's what the potential investors see, that the team there is solid.
So Akhil, if I can interrupt, that's projected, and I agree with you, but what have returns been over the last 10 years, say?
No, it's not projected. I can't share some of the stuff with you, but
whatever you can share, whatever you feel comfortable.
The last 6 deals that I'm talking about is based on actual
return. Okay.
Returns that are happening, both in terms of contracts deals we have gotten and the operating performance of the companies.
Great.
So my view is, as long as you are beating or meeting your operating performance, markets will one day or the other give you the valuation. So I think the way you judge how you're performing, right, because you can't get a benchmark every day. It's not a T20, it's like a test match that you have, is how well your operating performance is. And I think based on that, at least we feel very, very good that anybody who sees it objectively can see a huge amount of learning curve, both in terms of selection of the companies and the returns that we're getting. So I would say our portfolio is roughly about 1.6 mark actually.
Mm-hmm.
And that doesn't include some of the big marks that, say for example, a power plant, we don't mark it up till actually operations takes place. But but logically speaking, if your plant is like 95% complete, you should be able to mark in close to what it should be on the operating, but we have not marked it up. So as soon as that gets marked up, probably our mark will be about close to 1.6, 1.7.
So as a Bhangra dancer, I am I'm going to dance right around the question, but this is the way. No, seriously. I mean, even if I wanted to, I could not divulge details here in a public forum. But having said that, when we invest in India or any other geography, we're investing out of the same pool of capital that's here in the U.S. It was not and is not a separate dedicated India fund. So the threshold for the dollar invested here is the same as it is in India or any other geography. So from that standpoint, clearly, a venture firm like DFJ, the numbers that get thrown around out there are close to, so let's say, 30 to 35% IRR gross, somewhat south of that on a net basis. So that's what at least the threshold is. Hopefully, the performance will be north of that.
You still want to keep going on this question? No,
You're on the spotlight, not on the spot.
There we go. So I think both Akhil and Mohanjit have articulated this pretty well. My sense is that a lot of the funds that have come in the 2004, 2008 type of time frame are all trying to look at about a 2x type of a return in rupee terms to 2.5x. I think that's the range that people expect to make. Obviously, depending on when you came in, the FX is going to have a big impact on that. But those are the types of ranges people are seeing right now.
And would it be the same going forward, you think? So what is projected return? What would you be telling LPs is achievable realistically in going in today? I think that's what,
Yeah, I think listen, Sid, I think it all depends which part of the segment, again, that you're focused on. If you are at the very early stages, you obviously need to demonstrate a higher return threshold because of the risk that you're taking on. And then on the public sides, I think there is a mark for you that's available every single day. And so I think your thresholds are very different. But my sense is we're all, at the end of the day, absolute investors, return investors. And so if you can deliver 2.5x on a very consistent basis, most LPs are happy with that.
I don't have much to add.
Considering that you probably have the best returns last year. So, I mean, I don't know why you're jumping. All right, I'm going to open it up to questions. The lady here.
Thank you so much. My question is more specific to investing in real estate, and I think, Sid, you can answer some of
Oops, I'm being put on this.
Good question. Just wanted to find out, how do you think the REIT regulation is going to change the space for domestic and international players with their investment real estate?
So in 2005, in March, I visited the Urban Development Secretary's office, and he told me, Sid, the final draft regulations are on my desk. I'm still waiting.
So when it's ready, maybe.
It's such a hypothetical question that I don't understand. It's going to obviously make life easier for exits for people who are looking at income-producing portfolios. But when it happens is anybody's guess, and I don't think the government understands the complexity of the tax laws and is going to ease that up anytime soon. The finance minister made some concessions, but still the tax friction is so high that it really doesn't make any sense. At least that's my perspective. Akhil might have a different perspective on it from a real estate. Yeah. So that's okay. At the back there.
So you see a lot out there, through cases at FPS or even otherwise in the press about the gray zone of promoters in India and weak corporate governance. My short question is, how do you judge the worthiness of a promoter, and how do you run due diligence?
Is it to all the panel members or anybody in specific?
So, we invest in 20 companies, and I would say that the distribution of, if I say promoters' integrity, so we have we are on the right distribution, but even then we have a distribution within the distribution, right? I would say of the 20 portfolio companies, we had issues with real issues with 3 of them, and issues with almost all of them, right? That's just the nature of for Indian promoter. Now, diligence-wise, we obviously take forensic diligence. As all of you know, we have a company that gets into all the records. But the real diligence in India is, I always say that India is the most transparently opaque country. Like everything is known about, to everyone. So if you have a good network, you make phone calls, and no, I'm actually serious about that. There's not one investment that we made that we did not know everything upfront about the person, and all through the informal network, by the way. We learned more from the informal network. The formal diligence was you have to have it on piece of paper. But the real diligence is the informal diligence that we do, and having a network really helps. So you based on everything you hear, I don't think I could make any investment whatsoever, right? So there's not one promoter that I didn't hear something negative or the other. So you got to have a really cutoff line, and the cutoff line basically, and this part of a learning experience was that if our interests are completely aligned, will I have any issues with the promoter or not? And what we learned is, if your interests are not aligned, for example, if you have a convertible put, you're bound to have an issue because the promoter is not going to give you a low valuation. It's going to give you high valuation. So we learned that the hard way, that try and avoid a structure where you are not aligned with the promoter, because then you definitely will have some issues with the promoter.
Thank you, Akhil. My experience has been you need to control the bank accounts. Yes, sir.
Hi.
Yeah.
You answered half my question, the last one that you said. Amit Kanodia, Lincoln Capital. Good to see you, Mohit. On the debt side, credit side, getting the mindset to shift that this is not a PSU money that you have to pay back, and there's no renegotiations. Any thoughts on that?
To any specific person, or anybody on the panel?
Anybody who's dealing.
Anybody want to take that?
So the question is, how do you get them to pay back?
Without renegotiating every day.
Well, I think a lot of it goes to the points that Akhil made, like who do you lend to? Some of the other things, I think the referencing work that Akhil mentioned is critical. And the good news is you can reference very well in India. But the other things I would say is we look a lot at economic incentives. So one simple thing, this is a little more equity related, but not unrelated. We like high promoter ownership. Because then, frankly, the promoter has less incentive to siphon cash off. Okay, if he owns 70% of his company, he can steal your money, but he's not going to benefit that much. He owns 5% of the company, agency problem. And so one thing we look for is, okay, someone who has high ownership of their business is a good sign. Another thing we look at is the lifestyle's a lead. We like guys with modest lifestyles. It just works. Whenever we found the flashy guys, they've stolen our money. So, my family lives in Delhi, but, so Mohanjit and I wouldn't get funded being from Delhi, but the rest of those are some of the things we look at.
Right. Perhaps you price it in going in, right? The default. Yes, sir.
What industry sector would you not invest in India, public and private?
What sector would you not invest in?
I wouldn't say not invest, but I think be much more cautious where the greater the involvement of the government, right? No, I'm serious. Like, for example, and for example, what's his name? The guy who founded Nalanda Capital, Pulak Prasad. He said something very wise to me. I was looking at a power deal, and I said, "Hey, Pulak, what's your experience? I'm looking at this deal." He said, "I won't even touch it." So why? And this is his philosophy, that wherever you have the government involvement. So I was a contrarian, and I said, okay, if it doesn't want to invest it, then a lot of people won't want to invest. So you want to go where people don't go. But in terms of the risk, there's a much more riskiness, right? In any sector where the government is involved, whether it's road construction, power sector, or say, for example, even the one deal that I passed was this microfinance, because this government regulation did screw up the microfinance completely. Instead of a 40% charge rate they could charge only whatever 15-20% or something like that. So I think given what has happened in India, we'll watch for some more time, but be a little more cautious in where the government policy can affect your returns significantly.
So one more question, time for one more question. Karan?
What role do you see private equity firms playing in value creation at your investees?
Let me take a stab at that. I think you start off by answering that question by focusing on the promoters, right? So I think if you have selected the right type of promoter who is open for input, debate on value creation type of initiatives, I think there's a lot that you can do. We have someone in the audience today who's from an ex-portfolio company of mine where we worked extensively together. And so I think it all comes back to selection, partner selection as being a critical aspect of it. My sense is that the promoters are also discriminating now between what type of capital they get. I think depending on what their needs are, they are looking for a little bit more than just capital, some sort of expertise in specific areas. And so if you can bring that to the table, either through in-house teams or through specialized consultant networks, I think all of those things are helping. The industry is maturing. I mean, it's been 15 years now. So I think there are green shoots of that type of maturity that are showing up in promoters' mindsets as well.
One thing that I always tell entrepreneurs, whether it's here or in India, is venture capital or private equity capital is very expensive capital, right? So the waterfall that I use is grants, revenue, beg, borrow, steal, venture capital, right? So in terms of sources of funds, okay, and I'd say it a little bit tongue-in-cheek, but there has to be value because it's costly, right, to take money from all of us. So the value clearly, I mean, from my standpoint, for example, they're looking for that bridge that Sumir sort of started out with, is access to channels, customers, partners, that sort of thing. So a bunch of companies that we invest in, for example, are phase 1 Indian companies for India, and then phase 2 Indian companies for the rest of the world. And that's the rest of the world where that value creation comes into play.
We've run out of time, so I just want to synthesize what we heard today briefly. One, that sentiment has definitely turned. And I think we all agreed that hopefully, as reflected in this room being full up, India is again on everybody's radar. I think what we also heard is that people have learned a lot over the last 10, 15 years. Many will be able to apply that knowledge, hopefully. Many new players are accessing the market, so new experiences will be there. But if you really think back to the last 10 years, India probably went to the bottom of the cycle and then some, and has come back. So there's a lot of growth potential possible, and hopefully this time around there are more experienced people who have made mistakes, learned a lot, and will be able to apply that knowledge to both structuring their investments or picking investments, as the case may be. And lastly, you have a representation here of the larger firms and more entrepreneurial people, and at least 2 people who've done both. So as you think about what to do next, consider that there is an entire range of options. There are pros and cons of each, but persistence is the thing that matters most, both being an investor in India and in your investments into India. With that, I want to thank the panel. Thank you very much all for coming.